Hello, my name is Amelia, and in this video, I'll be covering cryptocurrency evaluation. And the goal here is to teach you why you can't evaluate cryptocurrency the same way you'd evaluate a stock. And so when you buy a share of stock, you're essentially buying a tiny slice of a real ongoing business. Think of it like owning a slice of that business, and as long as it keeps selling and paying its bills, whatever's left over, in part, belongs to you. Analysts estimate future profits back to today's dollars, and that's really all a PE ratio or a discounted cash flow model is doing. It basically discounts a future cash flow back to what it's worth today. Now, Bitcoin, for example, doesn't have a cash flow stream. It doesn't sell anything, so it doesn't generate a single dollar of earnings. So, when you hear about valuation models built for crypto, what's actually happening is analysts are trying to create an earnings style anchor onto an asset that structurally doesn't have one. So, for some history, back in 1936, the economist John Maynard Keynes made a distinction between enterprise and speculation forecasting. He mentioned the old newspaper beauty contests, the ones where readers would pick which face that other readers would rate as the prettiest. The prize would go to whoever guessed the crowd's favorite. So, buying cryptocurrency is closer to what Keynes calls speculation, the idea that you're not picking the asset you think is best. You're picking the one that you think everyone else is about to pick. On the other hand, buying a stock is on the enterprise side. A company does something, and the stock price is tied to that something or activity. Another distinction is that equities tend to be progressive, meaning corporate earnings grow alongside the real economy. Crypto tends to be speculative, meaning its price moves mostly on sentiment, liquidity, and momentum. Now, you've probably heard about how crypto is digital gold, which means it should hold its value no matter what the dollar does. However, in 2022, US inflation hit its highest level in 40 years, and Bitcoin fell by roughly 65% that same year. If if it were an inflation hedge, it really should have held or gained value. What actually happened was that real interest rates spiked and the Fed pulled liquidity out of the system. And Bitcoin, which produces no yield, got hit by the rising opportunity costs of holding it. So the takeaway here is that crypto doesn't behave like digital gold. It's more like a high beta barometer for liquidity and risk appetite. All right. So this tab here, it lays the two asset classes side by side. Equity volatility typically runs in the high teens annualized. Crypto runs in the 60s to 70s and sometimes higher. Stocks, they trade roughly around 252 days a year, and they're closed nights, weekends, and holidays. Bitcoin trades 365 days a year, 24 hours a day, which means the market can move while you're asleep. And you could read the rest of this comparisons. They're quite interesting. And so, what's different about the valuation of crypto is that the process is modeled in two separate layers at two different frequencies because they're answering two different questions. So the first layer is a monthly macro sensitivity model that asks, why do returns move at all? It's basically a regression of monthly returns on changes in the Fed funds rate, the M2 money supply, the CPI, and the S&P 500's return. Now, the second layer is a daily model that asks a completely different question. What does day-to-day texture look like? So it's a simple AR1, otherwise known as autoregressive model of order one. It says that tomorrow's return depends on a constant plus some fraction of today's return called rho. If rho is positive, that means momentum, where a good day tends to be followed by another good day. If rho is negative, that means reversion, where a good day tends to reverse the next day. And so, why not have just one equation? Well, combining the macro terms into the daily AR1 directly would let persistent macro trends get mislabeled as behavioral momentum in rho, and it would force daily frequency data into monthly frequency macro releases. So these two models are separate on purpose. Now, the macro model itself is fixed, meaning you don't have to re-estimate it. It's already been fit once on a blend of about 85% Bitcoin and 15% Ethereum monthly returns going back to August 2016. And look, the S&P 500 is the only parameter that comes out anywhere near statistically significant. This whole model really only explains something like 13 to 16% of monthly crypto returns. When you scroll down, you'll see the section where you can actually upload your coin's daily prices. So what you do estimate yourself is rho and daily volatility on a coin of your choosing. So in this section, you can upload your own coin's daily prices. For me, I chose Hype to analyze. The benchmark is going to be Bitcoin and the S&P 500. So Bitcoin and the S&P 500. And so if you actually don't have any data, then you can always press this load sample data. So the sample data is right here. But because I have my own data here, I can press estimate rho and sigma. All right. So on to the next tab. I do encourage you to enter what actually happened last month for each macro factor. Enter in the numbers and the site converts that into an implied monthly drift. And so just for fun, let's just put in the number that is highlighted here as suggestions. 5 for the M2 money supply growth, 0.3 for inflation, and 1.2 for the S&P 500 return. Run the simulation, and you'll see right here, it's tight near today, and it fans out the further out you look. So that's really the entire point of this graph, is that your macro assumption, it does carry a lot of weight here in the beginning, but further out, pure randomness takes over. And so this would be your medium outcome. This is basically what contributes to your negative return. And then these parameters contribute to your positive returns. So it really ends up with $65. All right. And so here you can draw the bands from the previous data. So this graph shows the upper limit, the lower limit, and the Bollinger line. The middle zigzaggy line right here shows the daily price of your coin. Now, if your coin is close to the upper band, kind of like this, then it's overpriced. And when it reaches the lower band, then it's oversold. So the Bollinger lines tell you if your coin is overbought or oversold, and you can read more about it up here. Now, for the backtest tab lets you see how a Bollinger Band strategy would have performed historically, but it comes with an important caveat. The bands in row used to trade the sample were also estimated from that exact sample. That's look-ahead bias. So treat this backtest as illustrative of how the logic behaves and not as some sort of proof that you found a strategy that will keep working into the future. And lastly, we have a quiz that could help test your knowledge and see if you got the concepts down. So go ahead and read through and just take the quiz. All right, so remember, crypto is a fundamentally different kind of asset, which means you need a different set of tools to price it. Anyway, thanks for watching, and until next time.